Okay, folks, so we've got about three big things to discuss. Number one, I want to give an update on the market and plays. Number two, I want to talk about what the SEC just said about something that relates to all AMC and GME holders as well as really retail traders as a whole. Number three, I want to talk about what just happened with the CPI report, how it may be misleading, and how this relates to what could be a new threat to the market. And the only thing that I ask in return for all of this is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, so most indices down, the S&P, the Dow, the NASDAQ, the Ruskies. The market just simply hasn't been able to shake off that September weariness. Lots and lots of risk-off trading. You had most squeeze stocks besides CEI just get obliterated today. And in regards to Atter, yesterday we were warning that Atter was very, very vulnerable to rug pulls because of the large amount of institutional whales in this. And today we could say the rug hath been pulled. Now for a round two rally, we need to see proof of concept. This is very much a whale-driven play, and if the whales are done, this play has been concluded. AMC had a down day breaking back below 50, though it has managed to hold its overall directional strength thus far. We'll see how it does the next couple of days. But in today's AMC segment, I want to take some time specifically talking about what the SEC chairman said. At the end of the day, and I've said this many times, the main reason that I've wanted to cover AMC so extensively is because I do believe that this is a very, very unique opportunity when everybody's paying attention to bring to light a lot of the unfair manipulative practices that have been going on forever. Because so many people have done just that and become aware, you have the chairman of the SEC spending a substantial amount of his time covering these issues. And so far, while we haven't had much action, we've had much more lip service than ever. Anyways, let's hear it from the horse's mouth.
As to the people and the companies that you regulate as chairman of the SEC, do you consider yourself to be their daddy? No. Then why do you act like it?
Oof, damn fat fingers of mine. That was the wrong clip of today's conference. Let me go on to the right one.
And I think the inherent conflicts of payment for order flow and rebates on the stock exchanges both may make our markets less efficient. And this is important for capital formation, and it's important for the retail investors that all three senators have already raised, is that retail investors may not be getting best execution, even if they get a price improvement, but there is price improvement versus a sort of out-of-date measuring rod. And if you measure against the wrong measurement stick, it doesn't mean you're getting best execution. So we're looking out for retail investors. If anybody on this committee or staff legally traded in the retail markets, there's like a 97% chance that it does not go to a transparent exchange. It goes to the dark markets or the wholesalers. And so it's harder to get best execution when you're not competing order to order. So I'm like deeply a markets person and believe in the competition of markets to bring those orders in competition.
So he's saying that if retail traders trade in the retail markets, that there's a 97% chance that that trade doesn't go to a transparent exchange, but rather to a dark pool or otherwise dark market wholesaler. So even if they are giving, in theory, price improvement over going directly to the exchange, well, there's still a strong chance that they're not fulfilling their duty to give best execution to the retail trader by nature that they're not all competing in the same place.
So I'm like deeply a markets person and believe in the competition of markets to bring those orders in competition.
But in a good market, you'd have a lot of parties competing for execution in one place. In the system that we have right now, you have a lot of parties in a lot of different places competing, creating what overall would be unfair executions. However, he does stop short, no pun intended, when talking about conflicting interests and blatant market manipulation opportunities that funds have when 97% of retail orders are transmitted through areas that aren't transparent. He doesn't talk about front running. He doesn't talk about using that information to their advantage in other parts of their business, like a fund that perhaps short stocks and also executes buy orders for those very same stocks. I don't know if you've heard of anything like that. Now backing up for a second though, that being said, at the end of the day, I know that a lot of people tease Gary Gensler. You just have to look at his Twitter posts or any social media form, and people are always teasing the man. And teasing is putting it nicely. Some people even call him Goldman Gary as a reference to him working at Goldman Sachs and now being tasked with regulating Goldman Sachs. But at the same time, it's not all black and white, and hey, government doesn't move as fast as we'd like to think it does. And the fact that he is consistently willing to, again, talk about these issues isn't as good as taking action, but it's much, much better than what we've seen from previous SEC chairmen, or chair people, chair folk, whatever they're called. So far, based on his words, he has been very, very pro-retail trader, and we'll see exactly how that ages and what happens as a result of that. Okay, inflation report, let's get through this very quickly. So inflation, not as bad as expected. It has so far stayed in line with the Fed's projections from earlier this year that the inflation growth rate would accelerate, which it did, and then start going down, which it is doing, the famous transitory prediction. This is now the third month of trending down since June, which had highs at 0.9%. Keep in mind though that these are growth rates. When we say cooling down, things are still getting more expensive, it's just the rate at which they're getting more expensive is cooling down. Most notable areas that brought down the report, fuel, oil took a breather down 2.1%, although it is still one of the hottest areas on a year-over-year basis. Used cars and trucks, very interesting. We were speculating last month that this would be the area that made future CPI reports look healthier than they actually were, because this was an outlier in terms of bolstering inflationary data back in early summer, especially like June and before that. We are starting to see some of the cool-off benefits of that happening right now. But with a lot of car manufacturers deciding to shut down production to a large extent over the last month even, it seems like this is once again going to ripple in the wrong direction a few months down the line. Whatever demand the new car market can't withstand is going to go straight to the used car market. Transportation services are down a sizable amount as well, 2.3%. Overall, though, a lot of the categories that matter to the average American consumer, food, shelter, services, medical care, well, these have all seen a cooling off of growth rates or a stagnation. Which is good, but considering this variant situation and considering that consumer confidence is near pandemic lows, it's likely that this cool off is largely driven by a cool down in the economic temperature. It's likely that what looks like a small cool off has largely actually been driven by a economic slowdown. And the reason that I say that is because there's a lot of pricing pressure still in place due specifically to all these supply chain issues. I understand that it's popular culture to peg all pricing pressures as a result of massive money printing, and I mean, hey, we did print tons of money over the last 2 years, and that certainly is going to have long-term consequences. But in the short run, most of the pricing pressures that we've seen are specifically because of supply chain shortages. Vehicle prices, for example, aren't skyrocketing because money printer go burr, they're skyrocketing because factories don't go burr. There's also quite simply a higher cost of doing business in the COVID world. It is very important to differentiate between pricing pressures. That way you can make projections that are more accurate when it comes to hearing, okay, well, the supply chain's getting back together in this area. How's that going to impact prices in this area? But here's where it gets a little bit darker. There's a big question to how relevant the CPI index even really is. The CPI index isn't a perfect measure of inflation because it only measures consumer inflation, inflation that affects a consumer's day-to-day life. However, it doesn't take into consideration inflation that has been reflected in real assets, like, for example, real estate and stocks, both of which have gone up substantially since the start of the pandemic. Now this gets us a little bit deeper into this market crash fear. Remember, in response to a crisis, the Fed will go and institute easy money policies, injecting trillions of dollars of liquidity into the markets, bolstering stability in lending markets, bolstering stability in the real estate and stock market, and in the medium run, a lot of that capital tends to find its way into pumping that real estate market and pumping that stock market. If you have really, really low interest rate money, that's low risk money that can then be used to buy more house, buy more stock, grow your exposure in a ton of different asset classes that promise a higher return than the near zero interest rate. And of course, eventually you do have to taper and rein that in, but hopefully you're reining it in during a period of time where the economy can offset the negative effect of you reining in the capital. But of course, one of the things that we've been talking about a little bit more is the medium-term threat of the S word, which is stagflation. In that scenario, not only will the Fed be more forced to raise interest rates in order to deal with rising pricing pressures, but they may have to do that during a period of time where the economy is going down. And raising interest rates would actually make it accelerate to the downside, penalizing people who take risk, taking money out of the markets, making the companies that the money in the markets we're investing in, making their actual sales numbers go down and down and down as the economy slows down. And all at the same time, the other consequence when you go into raising interest rates is, well, the debt. The massive, massive federal debt. The more we raise interest rates, the more the US has to pay on that debt load. The reason that in the past, at least in the recent decades, the US has been able to stave off rapid inflationary environments is specifically because it's been able to use its economy to overpower inflation concerns and seed into a taper. So anyways, what do you think about this market environment? Are we in for stagflation, or is this the start of a massive bull run? Well, let us know below. And if you're looking to learn how to trade with our step-by-step videos, our private chat, and of course our daily morning briefings, where we brief on all the latest catalysts each and every single morning in the pre-market, well, I'll go ahead and put a link to ZipTrader below. Coupon code FUTSTOPPER50 will get you $50 off before checkout. If you're wondering what broker to trade these stocks on, well, we like to send new traders over to Webull, and you will get 2 free stocks when you sign up with as little as $5 using our link below. Anyways, that caps off the video, and I'll see you in the next one.